Hello everyone, welcome to Accounting 210. In this video, we will talk about the first part of chapter 9, the master budget. So in this video, we basically focus on one keyword, which is budget. So what's the meaning of a budget? I don't know about the actual English name. You can Google it, or you can use your dictionary. But general idea is you have a plan, right? So that's your plan. So at the beginning of the semester, you plan to get an A in the class. You plan to study 40 hours every week. So that's the budget. So you will say, hey, why we want to have a budget, right? Many reasons we will talk about that. But general idea is you have the budget, so you thought, hey, you will get A in the class, you will get maybe 90. So that's your budget, right? But actually, your actual, right? You got A plus. I mean, like 99. So you can compare your actual with your budget. If you did better, like this is the case, then you can, pamper yourself, buy yourself something nice. But if let's say your actual only got 70, that's bad. So you want to figure out the reason and then keep improving. So similarly in the company, you cannot just say you work. You have to know, like, are you doing good? Are you doing bad? So you have to compare your actual with your budget. So that's the budget. The textbook also showed you basic general idea what we said, right? So we have some plan, then we act, and then we found out what's the problem, and then we figure out what's the strategy for the company. So next part, this is also from everything is from a textbook. If you have any concern for any specific part, I would suggest you to go to read the textbook to get a full story. So this one showed us our actual operating income, our budget operating income. And so in our class, we always put the actual on the left side, and then we put a budget on the right side. It's easy to memorize because our actual A always goes ahead of B. So you put A as actual, you put B as budget. And then what's the difference? In our accounting, we give it a fancy name. We call the difference as variance. We don't call difference, but it's just a difference. It's variance. So we figured out that, hey, we have sales revenue variance, we have variable expense variance, contribution margin. How do you get 12,000? It's 142,000 minus 130,000. So the difference is 12,000. So we call the variance is 12,000. And you do all the others, you found out you thought your operating income will be only 105,000, but your actual is 119,000. So you did better than your budget. You have a favorable variance of 14,000. So we talk about detail, I think, next time. But that's general idea. There is one terminology you may want to know. We call it budgetary slack. So what's the meaning? Is managers intentionally build slack into the budget for their area of operating. How do they do that? They over budget expense and then they under budget revenue. So what you guys say, hey, why they do that, right? With the over budget expense and then under budget revenue, why they do that? Many reasons. I think your textbook offered 3 reasons. I only recall 2. So the main reason is basically you budget more expense and then less revenue. So that's kind of like the worst situation, right? So your budget, you set your bar low, basically. You set your bar low. So when your actual is better, you will very be encouraged, right? So at the beginning of the semester, you just budget, you will get the letter, say you will just get 70 points. You budget for the worst. So later, if it turned out to be better, you will be happy. As the manager, they be promoted, they get bonus because they do better than their budget. So some managers, they budget very low, just turned out that the actual is better. Another reason is that when you budget kind of a low, you will get more resource in the future. So you say, hey, you know, my department, we have more expense. So later when you want to get more resource, maybe you can get more resources there. Okay, but make sure you read your textbook about getting better idea with a proper English. Next one, we talk about benefits of budgeting. I'm not going to say too much, but you know, it's planning, so we want to have a good plan. Cooperation and communication, you know, your budget with your next department, and then benchmarking, that's definitely very easy to compare your actual with your budget. So I would say if I test you, it's very easy to make a multiple choice. I will say, hey, what's the benefits of budgeting? Choice A, planning, choice B, this, choice C, benchmarking, choice D, you get A in accounting to 10, you will say, which is not, and then that will be the choice D. So get some idea. Next one, master budgeting. We said this is the comprehensive planning document for the entire organization. So that's the reason we call it a master, because it plans for all everything. Under the master budget, we have basically two sub-budgets. The first one is called operating budgets. So what does that mean? From the name, basically it tells us the daily operation. Oh, it said that, right? we take care of our daily operation. And then from that, okay, from that, what you will get? You will get budgeted operating, you will get budgeted income statement. You will get a budgeted income statement. We will show you, but general idea is when you have a daily operation, you make sales, you have to pay for the cost. So you have your revenue, you have all the costs, you got operating income. So operating budget gives you income statement, okay? Operating budget gives us income statement. And then next one, the second part, I said two main parts. One is operating, the other one called financial budgets. The other one called financial budgets. You will say, oh, financial is income. No, financial budgets give us a balance sheet. Financial budgets give us a balance sheet. Why? Because we will talk more financial budget, basically talking about when will you pay cash, when will you receive a cash, so you have a cash balance, and then you have account receivable, you have account payable, so those accounts are in balance sheet. So you definitely have to know what generates what. Operating budget gives us income statement, and financial budget gives us the balance sheet. And then I want to talk about the general idea of our whole thing. So we always start with the sales budget, okay? We always start from our sales budget. Once you know your sales budget, like let's say here, I want to sell 2 pencils. Then you have to know how many pencils I have to produce, right? I want to sell 2. You cannot just produce 1, right? So if this is the beginning, then you cannot produce 1 and you sell 2. You want to, you know, so the sales is not the same as production. It's kind of close, but it's not the same. So once you have sales, you can do production. So when you produce your pens, let's say you budgeted to produce 3 pens, then you have to know, hey, what are my direct material cost, what's direct labor, and then manufacturing overhead, right? That's, we talk about the production cost. You have these 3 little parts. Makes perfect sense. And then from there, you get other your operating expense. We talk about operating, remember your production cost and the operating cost. Remember that one is product cost, one is period cost. Okay, so we go back to that. We go back to that income statement. Revenue minus cost of goods sold gives you, well, gives you, what margin? Revenue minus cost of goods sold gives you profit margin. Oh my goodness, profit margin. And then minus all the operating expense gives you operating income. Okay, and then you get all the operating expense like the CEO salary, like the accountant salary. So from there, you can get our you can get our income statement, right? We said that gives us income statement. That gives us income statement. And then you also have the, oh, it said that, right? It gives you income statement. You also have the financial budget. It's kind of easier. You just have these three parts. Not actually just two parts. One is the capital expenditure budget. The other one is the cash budget. So from those two, you generate the balance sheet from our financial budget. From our financial budget. Okay, so I think I stop. I want to just give you some general idea of this chapter. I think next time we talk about each budget, you can say the annoying part of chapter 9. I don't think it's really hard. My only concern is we have, let's see, 1, 2, 3, 4, 5, 6, 7, 8. We have, at least 8 budgets. You have to make sure you understand those things. So I talk about more details and the numbers in next video, but we will use your textbook example. So we focus on one company. I think it said is Tucson, the tortilla company. They make a tortilla and then they sell at each case. So they sell 2 cases, 3 cases. And then I believe they said that their budgeted selling price is $20 for each case. So we will figure out their sales budget, production budget, and then all the budget in the following videos. Okay, thank you. Let me know if you have any question. I'll see you next time.